Thank you, KPMG, for providing IBSFINtech with this opportunity. I would also like to thank UG-san for introducing us and the strategic partnership between LSEG and IBSFINtech. Corresponding to the critical insight you shared on the utilization of market information and analysis, I would like to highlight how treasury management system is adding value to the treasury landscape in the current scenario. In today's globalized economy, corporate financial management has become increasingly complex owing to the interconnected nature of the global economy. The interconnectivity of economic and geopolitical events across the globe having significant implications on the financial markets worldwide. With inflation rising across the globe for the first time in decades, the global currency landscape has been significantly influenced by the effects of elevated interest rates. Further complicating the situation, the implementation of quantitative tightening policies by central banks worldwide to address inflation has led to a liquidity crisis. This in turn caused the insolvency of several major global banks. The geopolitical tensions and supply chain limitations have triggered a frenzy in the currency and commodities markets. As a result, business with international operations are facing challenges due to the FX volatility caused by fluctuating exchange rates that affect the value of their foreign currency assets, liabilities, and cash flows. For Japanese corporates, the depreciation of the yen has been particularly challenging, given their heavy dependence on imports, resulting in increased import costs and impacting the value of their foreign investments. Moreover, in response to these developments, the Bank of Japan is anticipated to introduce revisions to their yield curve control policy, which could have significant implications for bond markets worldwide. This move could further exacerbate the FX volatility and inflationary pressures faced by businesses. Therefore, the impact of these geopolitical tensions, supply chain limitations, and potential policy revisions by central banks highlight the need for businesses to adopt effective risk management strategies to navigate these uncertain times successfully. The banking crisis of 2023, involving the collapse of Silicon Valley Bank and Credit Suisse, had sent shockwaves through the global financial system. This unprecedented event also led to a severe liquidity crunch and affecting not only the banking sector but also the corporate sector across industries. The collapse of Silicon Valley Bank and Credit Suisse triggered a domino effect in the banking system. As market participants scrambled to mitigate their exposures to these institutions. This led to a tightening of credit conditions, with banks becoming more cautious about lending and interbank borrowing rates spiking. The result was a liquidity crunch that reverberated through the financial system, causing a shortage of funds for banks and corporates alike. The liquidity crunch posed several significant challenges for businesses, including number one, reduced access to credit. With banks tightening their lending standards, corporates found it increasingly difficult to secure credit, impacting their ability to finance operations and investments. And then number two, increased borrowing cost. The spike in the interbank borrowing rates translated to a higher borrowing cost for corporates, putting additional pressure on their financial stability. Third, rollover risk. Companies faced increased rollover risk as the refinancing of existing debt became more difficult and costly due to the liquidity crunch. Number four, disrupted cash flow. The shortage of funds led to delays in payments and settlements, disrupting corporate cash flow and potentially impacting their ability to meet operational and financial obligations. Amidst the present scenario, it is imperative for financial leaders to possess a comprehensive understanding of their financial standing round the clock. As businesses navigate the complex landscape of financial management, they must remain vigilant in their efforts to mitigate a range of potential risks. Geopolitical shocks have shown how corporates often need to pivot operations within very short time scales. Where previously treasury teams used to be focused on running lean as possible cash balances, now they're looking for techniques to optimize their returns in this new environment. Treasury is becoming more deeply involved in enabling digitization strategy that will be at the heart of all enterprises in the future. In response, treasury teams must gain control and visibility across cash flows, funding needs, and risk profiles as new business revenue streams emerge and others retrench. Regarding this, I would like to present you some of the current trends. As a result of the global slowdown induced by the COVID-19 pandemic, major global economies were forced to adopt quantitative easing and liquidity infusion measures. This, along with the supply chain disruption, caused a high level of volatility in the global currency markets, which saw the major currencies across the board taking deep hits against the US dollar. And further tensions in the geopolitical landscape kept the currency markets very choppy and volatile for a longer period of time. So that is depicted in this particular chart. Dollar index measures the value of the basket of six currencies, that's euro, Japanese yen, pound sterling, Canadian dollar, Swedish krona, and Swiss franc, with different weightages against the US dollar. As I mentioned earlier, major economies of the world took the path of liquidity infusion and quantitative easing to fight the economic slowdown caused by the pandemic. But these measures helped the economies to sustain during the slowdown, but they started to show the flip side once the economic activities started to gain momentum. Especially in US, the inflation started to rise month on month at an unexpected pace and created a lot of jitters among the policymakers. To tackle the rising inflation, US Fed was forced to hike interest rates at a rapid pace, which sent the bond yields soaring and had a cascading effect on other asset classes as well. Other economies too were seen following the suit and hiked interest rates to tackle high inflation and to maintain the inflow of US dollar investments into their economies. With dollar index movement, Fed hike, and rising interest rates, it is evident that businesses are functioning within an environment that is becoming progressively more uncertain and challenging from an economic and geopolitical perspective. The current economic slowdown and higher interest rates are on top of the mind for all the leaders, especially CFOs. According to a recent survey, visibility into global operations and risk exposures continue to be the most challenging and time consuming areas for the CFO office. Facing prolonged market instability, it is imperative for the organizations today to enhance their liquidity and finance exposures, cash forecasting, working capital, and optimizing the overall capital structure. This may take place in forms of transforming the cash continuum. Let's have a look at the additional challenges that the treasurers are facing on top of these macroeconomic issues. The most challenging aspect of managing FX risk, according to 83% of treasurers, are lack of visibility of FX exposures and forecast reliability. For 71% of the treasurers, manual exposure identification and capture processes are most challenging. 59% of the treasurers said that they had problem because of lack of understanding by business units. The fourth rank challenge related to FX risk, according to 55% of treasurers, is the ability to analyze exposures and measure hedging results. Inadequate treasury or financial risk management system is considered as a challenge while managing FX risk by 52% of the treasurers. Well, opportunities arise in the middle of every difficulty. At this point of time, CFOs must focus on the absolutes rather than on probabilities. With all that is going on economically and geopolitically, the majority of CFOs have prioritized digital transformation and technology advancements in the treasury domain. And we are witnessing a significant shift in the technology employed for creating and maintaining corporate systems. Companies that previously postponed their digital transformation plans are now hastening the process with a focus on updating the outdated architecture of their treasury systems or enhancing automation and data accessibility. Echoing the trends in a recent global treasury survey, the top priority set by CFOs for their treasury departments continues to focus on enhancing liquidity risk management and acting as a steward of risk management for the company. With 54% upwards, enhancing liquidity risk management is considered as the most critical mandate given to treasury departments by the CFOs. Mandates such as scalability, governing and driving working capital improvement, enhancing governance and control over domestic and overseas operation have moved up as compared to the previous years. So this makes it very clear that effective use of technology is the only way a treasurer who manages global exposures can consolidate and analyze information quickly and accurately. In this context, a treasury management system can play a pivotal role in helping corporates navigate the market volatility caused by the macroeconomic events. By providing real-time visibility into financial exposures and automating risk management processes, a TMS can enable businesses to better manage the challenges posed by commodity and FX market disruptions. A TMS can help companies manage their risk by providing real-time visibility into their currency and commodity exposures, enabling them to make informed decisions on hedging strategies. The system, in integration with LSEG's FXall platform, assists with executing FX trades, ensuring that businesses have access to competitive rates and that the trades are executed in a timely manner. This can help mitigate the potential adverse effects of currency fluctuations on corporate profitability and cash flow. Spreadsheets are widely recognized as being far from infallible, yet a surprising number of corporate treasury departments still rely on them heavily. Despite regular predictions on its imminent demise, corporate treasurers around the world continue to make extensive use of Excel in their daily operations. Now that we have a better understanding of why treasury management system is so crucial in today's dynamic business environment, let's dive into the exciting part, the benefits of TMS. A robust treasury management system offers corporates a wide array of benefits in navigating liquidity crunch challenges, from transparency and control to process efficiency and cost optimization. The TMS serves as a vital tool for informed decision making, enhanced corporate governance, and streamlined operations. By offering transparency, control, and visibility, the TMS minimizes manual intervention and automates critical processes, ultimately offering transparency, control, and visibility. This not only reduces the risk of errors, but also empowers decision makers with accurate, up-to-date information, enabling them to make informed decisions swiftly. One of the key advantages of implementing a TMS is its ability to enhance corporate governance. By incorporating the organization's compliance and risk policies, the system ensures adherence to regulations, mitigating compliance risks effectively. Furthermore, the TMS significantly improves process efficiency. Manual work processes tend to be time consuming, repetitive, and prone to human error. With the integrated maker checker validations within the workflow, guarantee accuracy and completeness before proceeding to the next step. Additionally, corporate governance, which is the most critical benefit of implementing a treasury management system, enables incorporation of organizations' compliances and risk policy. The TMS also facilitates seamless data flow both from external systems and within the treasury systems, simplifying tasks such as reviewing, authorizing, and compliance validation. By eliminating duplications and unnecessary manual work, corporates can optimize their full-time employee resources, leading to improved operational efficiency and cost savings. Identifying redundant resources becomes effortless with the assistance of the TMS. By adopting a comprehensive treasury management system that covers the entire spectrum of treasury, risk, trade, finance, and supply chain finance functions, businesses can enhance their financial stability and effectively manage their interest rate risk even in the face of changing market conditions and rising borrowing costs. Today, ESG is more than ticking boxes. It's about making a difference for your business and our world, creating sustained outcomes that drive value and fuel growth whilst strengthening our environment and societies. According to a recent Economic Impacts Global Survey of Corporate Treasurers, growing ESG requirements and adoption of digital technologies were amongst the top trends impacting the treasury function across all regions. Technology interventions in treasury and ESG go beyond traditional ERP systems. They enable specialized workflows for real-time collection of data, aggregation, and informed decisions. In this regard, the digital transformation of the treasury, risk and trade finance function of the corporate with an innovative treasury management system includes following impact on the ESG factors. The most critical being on the governance factor. Continuously adhering to and reporting risk management policies and controls contributes to compliance with ESG, better returns and ratings. This further gives access to newer markets and enhances investor confidence. An organization with a sizable treasury may use a system enabling ESG to effectively run their operations. Corporate governance is the most critical benefit of implementing a treasury management system as it enables incorporation of organization compliances and risk policy within the solution and industry regulatory requirements. This strengthens the organization's standpoint from corporate governance perspective. Increasingly, businesses across industries want to be ESG compliant, and a connected treasury management system can add to the bid. Coming to E and S, that stand for environment and social. Reducing carbon footprint, traditional treasury operations require significant use of paper as transaction vouchers, slips, and reports. Companies can meaningfully reduce paper use by adopting IBSFINtech. A SaaS-based tool, it enables cross-border accessibility all at once. This translates into saving in paper, printing infra, and ultimately cost and time. Social impact. Digitization automates redundant workflows and reduces manual tasks, which is why it is rated highly on the user experience, reducing the hassles of maintaining multiple spreadsheets or collating data from multiple sources to present to the board for providing the overall visibility. Therefore, the social impact of treasury management system is high, considering improved level of employee satisfaction from reduction in adjacencies, enhancement in efficiency and productivity, as well as improvement in management satisfaction as a result of having ease of accessibility of critical information in real time. Now, I would like to draw your attention to the remarkable digital transformation journey of the wholly owned subsidiary of Japan's automotive manufacturer Suzuki Motor Corporation, Maruti Suzuki, which is India's largest and a global auto giant, as they revamped their investment portfolio management processes, leaving behind inefficient methods and cumbersome spreadsheets. Maruti Suzuki's treasury team sought simplicity, sustainability, efficiency, and innovation in their solutions. As a result, they successfully reshaped their treasury operations by implementing best practices and met their forward-thinking vision. This transformative initiative caught the attention of Economic Times, India's leading financial daily, which covered Maruti Suzuki's progressive approach to treasury management. By embracing digitalization and adopting cutting-edge practices, Maruti Suzuki exemplified how companies can effectively modernize their operations and achieve significant improvements in their treasury management processes. By moving from spreadsheet models to a TMS, using innovative methodology for foreign currency risk management, sound investment strategy, and creating an efficient way to manage cash flow operations, the Maruti Suzuki treasury team was able to contribute to the bottom line of the company. Despite the many benefits of treasury management system, the digital transformation has its own challenges, particularly in relation to integration with the existing ERP, banks, and the third-party solutions of the corporates. Imagine a setting where your treasury management system, ERP, dealing platforms, market data platforms, and banks work together seamlessly like a well-oiled machine. In this case, your treasury team has a real-time visibility into financial transactions and can make informed decisions quickly and efficiently. The process of connecting a TMS to financial institutions, ERP, and third-party solutions may seem daunting, but it's a crucial step in achieving a combined ecosystem. In this context, IBSFINtech has emerged as a key player in transforming corporate treasury management by empowering businesses with an intelligent technology-driven decision support platform that facilitates end-to-end digitization of the treasury, risk, trade finance, and supply chain finance functions. IBSFINtech has established a unique position in the global market. The company has created a connected and integrated ecosystem that brings together corporates, banks, and other pivotal players in the ecosystem connected through a single platform, IBSFINtech. By providing businesses with a comprehensive suite of treasury management tools and an integrated platform, IBSFINtech is helping corporates navigate the challenges posed by market volatility and effectively manage their risk. IBSFINtech's treasury management system works hand in hand with LSEG data and dealing platforms. Derivative contracts booked on LSEG's FXall platform seamlessly flow into the IBSFINtech TMS, where further analysis of these contracts and their effectiveness in hedging and underlying exposures can be monitored. A TMS also requires a source of data to perform analysis on the data and perform valuations of financial products. This is where the LSEG data scope select comes in. IBSFINtech leverages the LSEG data feeds to value derivatives as well as assist in analytics. The offerings from IBSFINtech and LSEG together bring you a truly connected ecosystem. To conclude, in the current economic scenario, where the markets are uncertain and relatively volatile, treasurers and CFO need a proper tool to weather the storm and manage their ship effectively. Lastly, I'll wrap up by saying that a connected ecosystem is the new world order and is an imperative for a forward looking organization. Thank you.